Hello, everybody. Welcome to today's session. It's great to have you all. I can see lots of people coming in to the webinar today. Really, really excited about this. So good to have everybody today. So as a quick reminder, I know lots of you know me already. My name is Dan Wells. I am the founder and the CEO of the GrowCFO business. I'm really excited about this session today on scaling a company's finance function. I know that lots of people have talked about this previously. It's such a big topic. We're going to be talking about how to scale the finance function. We're going to be talking about how to scale the sort of wider company from a CFO perspective as well. I'm really looking forward to hearing from both Dav and our star guest today, Timothy Schott as well, who's some of you may already know through your networks. So yeah, great to have you all today. Let's get going. So yeah, first of all, Dav, do you want to say a quick hello, introduce yourself?
Yeah, absolutely. Thanks, Dan. Yes, my name's Dav Maseo, and I'm the co-founder of Xander. So we partner very closely with GrowCFO, and have been since their onset. So yeah, Xander has been around for about 5, 6 years now. We work with early stage technology companies, helping them scale up with finance leaders. And generally speaking, I've been doing that for about 21 years or so. So I joke and say sometimes I could be a CFO with that in mind. But yeah, so we are in New York and over the pond in the UK, and really excited to obviously delve into some of Tim's expertise to help a lot of the leaders on this call today. So yeah, that's a bit about me. So yeah, Tim, over to you.
Thanks, Dan. Thanks, Dev. My name is Tim Schott, and I'm pleased to be part of the GrowCFO network. And I'm happy to share my experience today with the group. My background is I started as an auditor at Deloitte & Touche. For the first part of my career there, I worked primarily on financial services audits. And then the latter part of my career, I helped build a consulting business as a part of Deloitte Advisory, where we gave consulting advice on capital markets, accounting, technical matters, both to audit and non-audit clients. And since I left the firm, I've had a number of different finance roles, the head of accounting policy, the chief accounting officer, and the CFO now 2 different occasions. And so I'm excited to be here today and to hopefully share my experience, and hopefully that will be valuable for you as you think about your own personal opportunities.
Awesome. Thanks, Tim. I'll take over from here, Dan, if that's good with you. So yeah, obviously, look, the plan of attack for today is just to get kind of an overview from Tim on his experience and his journey in scaling up businesses. As mentioned, hopefully providing you with something to take away, and to help your own personal journey or where you are right now. And yeah, so the initial kind of half an hour will be a 30-minute kind of session with Tim, a lot of questions being fired at Tim, hopefully not too difficult. And then we'll go on to answering live kind of questions from the audience. So please feel free to chip in whenever you wish in terms of questions at the tip of your tongue that will hopefully help you, as mentioned, on your personal journey. So yeah, Tim, I'm gonna whet the appetite for you and a lot of people by just kind of starting off with a few quick fire round questions. Hopefully we can get some good answers. So first of all, startup or scale up, Tim?
Scale ups. I've had a lot of experience with scale ups. I've never actually been a part of a startup from the ground up, from the first moment of founding.
Yeah, awesome. And if you could have two external advisors, who would you choose?
I've had a lot of success with Deloitte. I'm obviously biased. I was a partner there. I've been a Deloitte client ever since I left the firm, and I find their approach to be pretty balanced between compliance and being commercial and supporting the company's growth. and in the fintech market, I had a lot of success with KBW. I think they're a tremendous firm, and they're a straight partner to deal with. So I really enjoyed working with them as well.
Right. And best finance systems, technologies, you and your kind of team have used before.
The couple that I come to mind right away, NetSuite, obviously is key. There's a lot you can do with data in NetSuite to enrich it that gives you the ability to have different looks at the business down the road. Cost centers is a good example. You can do your budget to actual in there as well. Another one is Blackline, which is a very good way to not only close the books, but keep track of all the documentation that you used in order to complete the process.
Yeah. Biggest hiring mistake?
I think the biggest one that I could think of is waiting too long to get the right people with the right skills in place. I think there's a lot of situations where, you have certain people and they're very valuable to the organization, and maybe they were even more valuable at different stages of the company's growth. But I think the biggest mistake sometimes is to wait too long to get people with the right skills for the next phase that you're trying to plan for.
Best tip for managing a superstar?
Just give them space, stay out of their way. So, set expectations and try to treat them somewhat the same as other people, but give them, more space to operate.
Yeah. And what's been your biggest superpower, do you think, which has allowed you to become a CFO?
My biggest what?
Superpower.
I like to build teams. So, I really enjoy building teams. I enjoy the camaraderie and I enjoy helping build the infrastructure that allows the company to grow. And the first step in that really is people. And so I think it's important to be a good people manager and to be a good people recruiter in order to be successful.
How ready were you, Tim, on a scale of 1 to 10 before you took that first CFO role?
I mean, I would say probably around a 7. I was a chief accounting officer prior to becoming a CFO. I also had a background as a partner at Deloitte, so it gave me a broad experience in terms of finance operations as well as capital markets. And so I would say that I was reasonably far along before I took my first role on. Obviously, I reported to the CFO on a number of different positions after I'd left the firm, so I had that experience as well.
Right, Jim, that's awesome. Nice quick fire to get us all warmed up. So yeah, now kind of delving further into your experience, I suppose, Tim. When it comes to obviously the topic of discussion today is scaling up. What experience or experiences can you draw upon to kind of highlight, I suppose, your scale up experience and what contributed to that success, would you say, in terms of scaling up successfully, let's say?
One example I could give is we put in place a written strategic plan. So, the founders had an amazing idea for what they wanted to do with the business. And we actually brought in an outside consultant. We facilitated an offsite, and we started with kind of the basic principles. What's the headline when you're successful down the road? How would you define success? Where are you going to win? How are you going to win? And what's unique about your business? So I think that was a really critical exercise. And then I think the next thing that I've seen in my experience is making sure that there's alignment across the leadership team as to what that goal is, and that everybody is working towards the same thing. So if there was 2 simple things that I would do if I was starting out, those would be the 2 things that I would start with. And you don't necessarily need to hire a consultant to do that work. But if you have a written plan, you know exactly what you're trying to accomplish, like what problem are you solving and how you're going to do it. And then having alignment of the key members of the team, I think that's critical to your success.
So underlying that, Tim, is, I suppose, culture being the main thing and making sure everyone's on that same train and painting the vision ultimately, which I think is a big pain point for a lot of growth companies who are going from X to Y. How do you maintain that kind of culture of dynamism and enthusiasm as you scale? which yeah is obviously really important as you've mentioned there.
Mm-hmm.
Um,
Yeah, I mean, you have a lot of enthusiastic, knowledgeable, experienced people, and they know how something worked before. But if there's not alignment in terms of what the kind of new defined goal is, it becomes hard to scale to the next level.
and kind of added to that, I suppose, culture is obviously really important. It's probably up there as number one, number two. What are the kind of key metrics that you would evaluate when looking at growth and scale up? What kind of KPIs would you advise entrepreneurs to evaluate from a finance angle to ensure that scale up is done in the best possible way?
Yeah, I mean, obviously revenue is paramount. And most startups are highly focused on revenue. There is one thing that, you need to be cautious about, which is revenue can't come at any cost. So you need to be conscious of what kind of margin you're driving towards, and you need to also understand for every dollar of cost you're adding, how much revenue you're adding. There needs to be a leverage multiple as you're growing that cost base. There needs to be a leverage multiple in terms of how that revenue is growing. So I think that's one thing I would say. And then the other thing, just a little bit off topic, is there's a lot of non-financial metrics that are very important to scaling a company. Customer satisfaction score, for instance, net promoter score is another example. What is your customer acquisition cost versus your lifetime value? So there's a lot of what I would say non-traditional metrics that are also important that you need to keep in mind, because when you're talking to investors, they're going to want to know other things. They're going to want to know, for instance, what is your product performance? What is your market share, et cetera. So it's not just about the financial metrics that people think about, traditional top line, bottom line. There's a lot of operating metrics, even within the business, that I think are critical. What is your go-to-market timing? How long does it take you from when you start to launch a product to when you're actually able to start to sign up the first customer? So it's important to keep in mind some of those non-financial metrics as well.
And have those metrics kind of tended to fall in the house of the CFO, would you say, Tim? Does it come from the CFO, or is it kind of a joint, across all stakeholders and all key leaders of the organization as to what, KPIs there should be?
Yeah, I think it's much more across the organization. Especially in the kind of fintech world, you have a lot of data scientists who are doing data mining. That's an incredible wealth of knowledge and resource that should be tapped in terms of helping to manage the company's financial success, especially when it comes to measurement of key metrics. And one of the things that's different, whereas accounting, there's processes and standards that are common and understood. When you get off into some of these other non-financial metrics, there isn't necessarily that bright line standard. So I think one thing I would say that I've seen be very successful is writing down what your policy is, how you're going to measure it, how you're going to parse it, and so that there's, again, alignment across the organization when someone and then put some governance around it as well. Not everybody can be able to put out their own kind of metric anytime someone asks. There has to be kind of an owner, a named owner from a governance perspective, so that there's a single source of whatever that other operating metric is.
Mm-hmm. And popular topic of discussion right now is of course fundraising and raising the right amount of capital to be able to scale up. What are some of the strategies that you found successful in that sense, in being able to therefore execute successfully when it comes to fundraising?
I guess a couple of things. Obviously, the market, especially the last couple of years, has been extremely challenging. In my conversations with other tech companies, a lot of the CFOs mentioned that most of their funding in the last 2 years, especially, has come from their existing cap table, and a lot of that came at a pretty significant cost. So I think that that's a good indicator of kind of where the market is. I think the ability to just raise money based on revenue and revenue growth is something that may have happened at a moment in time, but it could be a long time before that moment comes back. There's a heavy focus on margin and your ability to extend your runway. And so I think the other thing I would say is that you need to have alternate plans to deal with different scenarios depending on what may happen. So, a growth plan, base case plan, a down case plan, so that you have something to execute off of, depending on how the business operates and what your availability of funding is.
Yeah, and we advise CFOs all the time in terms of being able to tell that story as well is really important, because they're standing on that stage with founders sometimes, pitching in front of investors. So the ability to tell a story, Tim, I posted on that a few days ago. How important is that, and how confident do you have to be as a CFO to be able to pitch successfully to the investors, and what skills could people develop there to ensure that they give it their best shot?
Yeah, I think there's a couple of things. Obviously, it is a story, right? So you need to be able to explain exactly what the problem is that you're solving and why your business is unique. And you need to be able to illustrate it in an impactful way. So maybe your business is unique because of your ability to attract customers cheaply, even notwithstanding the problem you're solving, but what is also unique about the business and why it makes for a good investment, not just a good business. And I think the other thing I would say is that you need to understand, what's important to your audience. So as these companies go through their journey of growth, the investors that they're talking to have different metrics that they're focused on. They have different performance expectations that are important to them. And I think a lot of times you see people, they're very focused on how they raised capital last time and what metrics were important there, versus how they need to raise capital in the next round and what would be important to that level of investor. So, I worked at a business where, we were very adverse to paying dividends, for instance. But as the company grew and scaled, the investors that were interested in our business model were very interested in, a steady, earnings-based, cash flowing business. And it just so happened that structuring the dividend in a certain way allowed us to be eligible for certain ETFs. And that's a good example of thinking about the next level of investor. And you could just take that kind of analog and translate it into other things. But the next level investor was interested in our ability to grow our dividend year over year, even if it's just marginally, so that it gave the investors confidence that this was a strong cash flowing business. And so if you just think about that, maybe in the startup world, there's a lot of people who are focused on growth at all costs. There's a lot of people who are focused, and whatever story comes with that. But the next level of investors are much more focused on EBITDA. And they have other metrics that are more important to them. For instance, how much are you spending on innovation versus cost of goods sold? What is your overhead rate versus your total cost spend? And so they're much more focused on financial operating metrics that go way beyond revenue.
Yeah. So as a CFO, you've as a hypothetical situation, you've secured the funds. The founder wants you to allocate funds for growth. How do you maintain that financial stability yet invest in growth strategies, and therefore I suppose manage the expectations of the CEO or the business owners, because of course there's two sides of the fence here. As a CFO, you're there as a commercial decision maker at times, but also you have to maintain things at the back, I would imagine.
Yeah, I mean, I've seen this in a lot of different scenarios where you make little bets in different places. I worked at a public company where they had a bet that they would be in wealth management, for instance, and it burned, a significant amount of capital year over year. and the business never took off. There never ended up being revenue. And I think a lot of people think of those as inexpensive options, but every one of those inexpensive options comes with a significant cost. So I think the key thing is to be focused on what is making money right now, and what can be put off until you can otherwise stabilize the earnings of the business before you kind of make the next round of investments. It's easy to get distracted by the next shiny opportunity that comes along. And so I think it's important to stay focused on, what is your primary opportunity that's in front of you right now.
Yeah, and I suppose closely related to that is cash flow management right now. Is there any particular, have you had any experiences where cash has been quite tight and you've had to install an effective cash flow management tool or forecasting tool which has helped, or kind of any particular steer that you provided that has helped a company from a cash flow management perspective, which of course is, I'm sure, very much so a popular topic for a lot of the finance leaders on this call today.
Yeah, I think one thing that was interesting was in focusing on revenue and growth. In some cases, the products weren't necessarily set up in the right way to optimize the collectability of that revenue. In some cases, the business was structured in a way where revenue would be collected in the future, and there's a couple of issues with that. Obviously, the collectability of revenue is probably the most important thing that affects your working capital. And so making sure that the finance has a seat at the table when you talk about the structuring of products and how that revenue will actually be collected and under what terms. And so another way of saying that is if you're offering financing, it can't be free. And if you can't get that, and if you create a capital intensive business and you don't have access to capital, you're giving away something for free. And the issue with that becomes you're giving away something of value that the customer doesn't necessarily appreciate. They don't really see it as a value add. And so I think the key thing is to have a seat at the table in terms of the product structure and to make sure that the collectability is assured. And otherwise, if you have access to capital and you're able to finance things, that needs to come at a positive spread, obviously.
Yeah, and operational efficiency obviously is you could argue very important when you're considering the cash flow piece as well, because ultimately that affects how much cash is churned. I mean, what do you look at from a kind of operational efficiency perspective to ensure that the business is performing in the best possible way and the most efficient way, would you say?
From a cash perspective?
Yes, or kind of general setup as a business.
Yeah, I mean, from an operational efficiency perspective, I think the other thing that I've seen be successful is that there's a clear alignment between the finance team and the operations team. So, whatever treasury management activities exist on the operations side of a business, those need to be well understood by the finance team, before you kind of move forward with a plan.
Yeah, and that you mentioned earlier, Tim, being at the table, when those certain decisions are made as a CFO or as a finance leader. Does that education come from the start in terms of, look, to the founder, to the CEO, it's important that we're at that table when key decisions are made, because otherwise we'll lose control of cash or where we're going or how we're growing. Because you could argue not every CEO or business owner values finance in the same way that other businesses do. So does that managing of expectation need to come straight off the bat in terms of, look, we need to be on that table when decisions are made?
Yeah, I mean, I think it really comes down to your mandate as a finance leader and just having clarity around that. It could evolve as you get a better understanding of the business, but there does need to be a clear understanding of what your mandate is and how far it goes.
Yeah.
And that does need to come from the top, obviously.
Yeah. And when it comes to the vision and the kind of mission mission statement, how important is that kind of in terms of being tied to the finance house as well? You know, of course, you don't want the founder or the business to make any lofty mission statements in terms of becoming a unicorn in 2 years, for example. Is that kind of part of your remit and you know kind of role as well in terms of, look, the mission statement, the vision of the company needs to be realistic based on X, Y, Z from a finance perspective?
Yeah, I mean, I think that goes back to kind of the first question, which is strategy and alignment. And part of that strategy alignment is, you know, what is financially feasible? So you could just start out with, for instance, we want to have a company that is worth X. That implies EBITDA of Y. That implies growth of X. And that implies a production from a volume and customer perspective of some other number. And then you work backwards, and someone in the operations group looks at that and says, there's no way that we could support that level of business. So
Yeah.
there has to be a financial element to that. And I think that's and it's helpful for the leadership team to understand how the operations of the company translate into the financial outcome.
Yeah. Right. And when you kind of, sorry, there's a bit of a delay there. Apologies for that. When you come into a new company, Tim, you know, are there kind of certain checklist exercises that you do from a due diligence perspective, so as to kind of know what you need to implement in the first 30 to 60 days? You know, do you look at the systems first, the processes second, and then the people side? You know, if we had to categorize in those three kind of silos, or do you look at the people first and then systems and then processes? Yeah, is there a kind of evaluation of that scrutiny as soon as you go in?
Yeah, I mean, the way I've seen it be the most effective is you start with people, then you move on to process, and then you figure out what your best technology solution is. So, you know, if you have the right people with the right skill sets in the right places, you know, you can have operating processes that are effective, even if you don't have every right tool at your disposal implemented the way you want to have it. And you can gain that efficiency down the road with a technology implementation, but I think people and process have to come first. So, and a quick side note on process, especially, you know, in a scale-up world or a startup world where you're creating something that's de novo, you really need to think about flowcharting. And I know this sounds like a minor thing, but it's incredibly valuable to have key processes flowcharted. It's great for business continuity. It's great for onboarding people. It's great for explaining to the auditors. It's helpful to explain to other parties, risk management, external stakeholders, investors. People ask you questions like, what is your process for X? And you have a visual that you can walk them through and you maintain it. They're really inexpensive tools to do this, and it's an incredibly valuable thing, especially in the operations sector, because, you know, in some of these cases where you're building something new, you're taking talented people and you're putting them to solve a problem. Having that discipline to put flowcharts in place around key processes and to maintain them going forward is so important.
Yeah, and kind of closely related to that too. A lot of the questions we get is, when do we hire a CFO? When do we hire a controller? When do we hire a head of finance or a VP of finance? Do you feel like that there's a kind of chronological kind of path there in terms of from the start of the business to then getting to a certain stage? Should they have hired certain people by, would you say?
Yeah, I mean, I think it's really a function of, you know, what the business requirements are. So, you know, do you need to have GAAP audited financial statements, for instance, in order to be able to operate? You know, how sophisticated do you need to be to raise capital? And so I think if you could think about some of those key questions, then it becomes more intuitive as to when you need certain resources. So obviously, capital raising and capital allocation is key from a finance perspective, and once you get to a point where you have demonstrated that you have a product market fit and that you have growth and that you have a path to raising capital in substantial quantity, I think that's a time where you would need a CFO, someone with not just an accounting background, but also finance and capital markets experience. And I think from an audit perspective, having someone who runs the books and runs the reporting, who's not a CPA, if you're trying to go through an audit process, becomes very challenging. And so, if you're going to be subjected to a rigorous audit, having a CPA is critical.
Sure, no, that makes sense. And when it comes to, I suppose, personality traits as well, Tim, I suppose a finance leader at early stage needs to possess different skills or different traits to then be able to adapt to a later stage business. Would you say, Tim? I mean, yeah, Series A, Series B, obviously people need to be very scrappy, hands-on. As you mature, the function becomes a lot more siloed. So the argument is that you need people that have a specific focus in controls or finance. So you probably need to hire different people at that stage. Versus the early stage, or would you consider people who are from a smaller company hands-on, which is Series A, for like a Series D company? Is there a kind of a difference in traits that you look for across different stages?
Yeah, I think in the beginning you need to be able to wear a lot of different hats. So over the course of my career, I've been involved in technical accounting policy. I've been involved in tax, governance, controls. I've been subjected to multiple PCAOB audits. You need to be able to be adaptable if your company is regulated. That's key in the beginning. I think as you become more mature, you need people with those developed skill sets and those key backgrounds that you need in order to get to the next level. So I think you need to be able to wear a lot of hats in the beginning, and I think you need to have deep expertise towards the back end of the process. Dab, I think you froze a little bit there during that last part. So,
And Tim, just whilst we're waiting for Dab to come back, there's a few questions that have come in. So yeah, what type of things do you think about when trying to avoid overscaling after going for a fundraising round? Thank you for that question, Alex.
Things to
What types of things do you think about when trying to avoid overscaling the business after going through a fundraising round?
overscaling the business. I mean, I think after going through a fundraising round, again, I think the most important thing I can think about is to be focused on what your objective is. I think when you finish a scaling round and you have a lot of money in your pocket, it's easy to get distracted. It's easy to look in a lot of different directions. So, I've seen situations where, you raise capital and you end up investing in things that you may not have otherwise invested in if you didn't have that money in your pocket. It was non-core before you got the money. It's non-core after. It may not need to be funded. So I think that's probably one. And then the other, I think, is to make sure that, as you're growing the business, that you're still able to maintain, the quality that you want to be able to deliver. So, it's easy to grow, but you need to be able to make sure that you're still mindful of what the customer experience is. And so I've met CFOs who were personally involved, for instance, in client delivery. They would own specific relationships in order to have a pulse on what the outcomes were for customers as the company was growing, so that they could have direct feedback. in that process.
Great. Thanks, Tim. And thank you for that question, Alex. Dab, back to you.
Yeah, sorry, Dan. I don't know what happened there, but hey ho, technology, as they say. Yeah, Tim. So, and generally speaking, in terms of I think my question last was around the particular traits you look for at early stage versus latter stage. I think one of the questions we had was how do you, and we get this a lot, how do you test for someone's scrappy nature and hands-on capability? Because of course, there's candidates who've worked at big companies, and it's difficult to therefore really obtain or gather whether they can be scrappy enough. So how do you test that particular individual with that, around that particular trait, would you say, Tim?
Yeah, I mean, when you're scaling a company, obviously recruiting is critical. From a finance perspective, you need to be really hands-on with the HR function in terms of who you're recruiting and why and how. I think the answer to your question, where I've seen it be successful, is in a few different ways. One is you could ask very pointed questions in terms of people's experience. What was their individual role in something versus something that they were involved in? What exact part did they play? Another thing I've seen successful is case studies as a part of the interview process. And I think the one that we discussed earlier was, asking people to come up with a 60 or 90-day plan as a part of the interview process. And that will give you some insight in terms of, how hands-on they will be versus how hands-off they will be. When you're in this startup world, or you're trying to scale a business, in some cases, you need someone with deep technical expertise. In some cases, you need to be able to train people to do jobs because, again, you're creating something new. And so you have to be flexible in terms of what kind of talent you're trying to attract. So, I mean, I've been involved in recruiting of people off campus, where we taught them how to do very, very technical jobs. But we had a great training program that we created prior to the onboarding process that we could put them through. And our philosophy was, these are very bright people. They have incredible degrees. We're going to make them very focused on a particular thing, and we're going to help them along that journey. In those cases, we created the training tools. If you're relying on somebody's expertise, I think you need to have a much clearer understanding of exactly how they will pick up tasks. Because in a situation where you're trying to scale up a business, a lot of what is being done is people wearing a lot of hats and picking up tasks individually. That's a critical part of the success of the operation.
Yeah, and innovation and obviously improvement or continuous improvement are obviously very much so apparent when you're at that kind of scale up stage. So how do you foster innovation and encourage, I suppose, that culture of continuous improvement, Tim, across the organization and specifically within that finance and accounting house?
Yeah, I think something that I've had a lot of success with is involving even kind of the lowest level staff person in, what the project is, making sure that they have an understanding of what the goal of this project is, why it will make their individual life easier. Why it will be more enjoyable work experience for them. They'll be doing more analysis rather than more data input. And to bring them along the entire journey of a vendor selection process, for instance, or a process improvement, to make sure that you have buy-in from the team all along, as opposed to just saying, hey, this is what's going to happen. This is how it works. This is who's going to do it. This is who's going to lead it. This is who's going to do the blocking and tackling work. I think you have to engage the entire team in terms of, especially if something is really important. And I think the other thing is you need to be able to draw a straight line between, why you're making these improvements and how it supports the company's goals. Because that's also makes a tangible connection to the team that they otherwise wouldn't be able to come to on their own.
Yeah, great. And Tim, I want to get your kind of take on, I suppose, more the development side of you personally, because a lot of the kind of attendees today are kind of aspiring CFOs. I'm part of the GrowCFO platform, of course. And I suppose, how did you get to that first kind of CFO role? Because obviously working within Top 4, I know you kind of reached quite a senior. You became partner there after 19 years, and some find it difficult to transition from your practice or your kind of Top 4 into commerce and then eventually CFO. How did you do that? And did you kind of, I suppose, map that out as soon as you left Deloitte and say to yourself, look, I want to become a CFO in 5 years, and this is what I need to do to get there? Or did it just fall on your laps as such? I'm sure that wasn't the case, but what advice can you give to those aspiring kind of CFOs and potentially how they could get to that kind of the CFO role in the next 5 years, let's say?
Yeah, I think you touched upon probably the most important thing is mapping it out and working backwards. So, I had colleagues, for instance, who wanted to be in the private equity business, and they mapped it out, working backwards. They went to the M&A function of a Big Four accounting firm, and they worked on acquisition, they worked on due diligence, and then they worked backwards, and they used that as a springboard to get the job that they wanted. So I think that's one, is to have a clear picture of where your goal is so that you know what the building blocks are. And then how you get the building blocks, it's really just a function of, what makes the most sense for your career path. So in some cases, it could be going back to school. In some cases, it could be supplemental learning. In some cases, it could just be on-the-job training. So I think the most important thing is to make sure that you know what your gaps are. So, if your background is as a controller and you want to be, a finance leader, you have to be able to speak the language of finance. You have to understand what's important. You have to think like a banker, not an accountant. So you need to work backwards from the EV that you're trying to achieve, for instance, and what kind of metrics give you that EV outcome rather than just looking at the balance sheet, looking at the P&L. So I think it's really those two things, is working backwards from your goal and knowing what your gaps are and how you plan to fill them.
Yeah, and touching upon that point, of course, the CFO is the commercial decision maker and the compliance officer. So, yeah, to your point around, if someone has that controller background or a CPA background, then it is vitally important to gain that financial decision making experience as well, and get under their belt budgeting, forecasting, financial modeling, fundraising, for example, and then kind of you see that transition. Whereas what you don't see, Tim, in our experience anyway, is if someone started off in finance, then go into controls. So so you would you argue, I mean, just putting it out there, someone with a CPA, controls, and then gone into finance is more well-rounded as a CFO versus someone who started off in finance and then became a CFO? What are your thoughts on the kind of two schools of thought there?
Yeah, I mean, I think coming from a accounting and controls background, you have discipline, that is so important. Giving out correct financial information, for instance, because it went through a process. I think you need to be entrepreneurial to be a finance person. You need to be more in risk-taking mode rather than risk management mode. And so it's a completely different mindset. So I don't think either one or the other is better in terms of what makes a valuable CFO or an effective CFO. I think it's more just an awareness of what the differences are and how that relates to your individual career path. So, some people are not comfortable with risk taking. Some people are not comfortable with going through all the steps of doing something in a very process-oriented way. And so I think it's just a matter of, knowing what your strengths are and playing to those.
Yeah, great. Tim, I'm conscious that we've got quite a few questions that have come in and few that came in before the session. So what we'll do now is we'll kind of drill into those questions and get your thoughts, if that's okay. So, yeah, the first question is coming from Will, and he's asking, in addition to switching accounting software, you mentioned NetSuite, what are some unscaling the finance and accounting function?
I would say, especially in a startup, one of the biggest pain points is the whole process of managing both T&E and spend in an efficient way. It's easy to get caught up in doing things in manual processes. There's a lot of vendor management in a startup. The ecosystem of vendors that is valuable to startups it's mind-numbing in terms of its scope. And so I think starting out with a clear plan in terms of how you're going to manage that. I've seen Concur used effectively. I've seen it used very effectively in some cases and not as effectively in some others. There's plenty of providers out there. Ramp is a good example. Even some of the card companies like Amex have tools that allow you to direct connect to NetSuite, so that you don't have to, so that you can basically set up the expenses, expense tracking, cost center tracking, and the wiring all in one process rather than having to do things twice. And so I think there's a lot of spend management software that's out there. It's very inexpensive to implement, but it saves an extraordinary amount of time, and it allows you to be more focused on the management of the business rather than just managing the closing of the books.
Right. There's some tough questions here, Tim, so stand by. Next question is from Caleb, who's asked, what is the example of a growth strategy that didn't work and what was done to rebound from it? Maybe a bit of thought needed there.
Yeah, I mean, I think the growth strategy, for instance, when you're trying to move internationally, you have a good business, you have a good brand, you have a great product, and you just want to move into a new market, and you do it more or less on your own. And I think, what I've seen be more successful is where you have a partner. So, I was involved in a transaction where we were trying to create a shipping finance business. And, if you're in the shipping finance business and you don't have a partner who's located in Greece, for instance, it's hard to be successful. And so I think that's a simple example. If you're moving into another jurisdiction, you should have an operating partner that's going to support you to make sure that you're successful from the get-go. And where I've seen that not be successful is if you try to do it on your own. You can set up very complex regimes, legally, compliance-wise. Getting a passport to operate in the EU, for instance, costs a lot of money. If it doesn't come with revenue, the cost of exiting that structure can be incredible. So, there's quite a lot of tax advisors that need to be hired just to close a business, for instance. And so you need to have a clear plan in terms of how you're going to grow that business from day one, and doing it with a partner, in my example, was a lot more effective.
Yeah, and I suppose it goes to that point of you can't do everything, or you can't be expert in everything. So yeah, surrounding yourself with the right partners is really important, and tapping into their strengths is key. So yeah, no, good question that was, and thanks for your response there, Tim. The next question comes from Jose, who's asking, what type of things should a CFO think about when scaling a company, going from a second kind of generation mid-sized local business to a global firm, which I think you've answered in part, and I know, Tim, from your experience, you've scaled businesses kind of internationally, and as you alluded to there, you've got a strong international slant to your experience. So yeah, hopefully you can answer this pretty well.
Yeah, I think another thing to keep in mind, which we haven't really touched upon a lot, is inorganic growth. Um, Especially as you become known in the marketplace, inorganic opportunities are going to come along. And so you could think about those in really two ways. One is a transformational inorganic opportunity. And that's the kind of one that, you would have already had a relationship with that company. You would have relations with them. Your leadership team would be in contact with some of the people on their leadership team. You would know each other. And on the other hand, you have kind of small bite-sized acquisitions. Maybe you're buying a team, maybe you're buying a piece of tech. So I think another key thing to think about in terms of scaling up the business is to have both an inorganic and an organic growth strategy, and to make sure that they're not competing with each other.
Great. There's some brilliant questions here. I probably should have stepped aside and let the audience take in the whole session, but let's see if we can get through a few more of them, Tim. I don't know who this is, Ajia possibly, but what is your advice on managing a finance team that is reactive and requires hand-holding, i.e. there is no initiative, proactivity, or interest in making things better? Is it possible to replace everyone on joining the company, but also impossible for the CFO to do everything by himself or herself? So I suppose it goes back to that question I raised in terms of what do you do in the first few days of joining a company? And I think you mentioned, evaluating people first, and what is the action point if the people you're evaluating are not good enough? What are your next steps thereafter?
I mean, in my experience, it's a couple of things. One is you need to have people who are able to bring that leadership at the next level down of management. And secondly, you need to empower them to make their own decisions around people. So obviously, if you have a lot of experience, recruiting people, you could certainly give advice. But at the end of the day, if you're giving over management responsibility to somebody, you're giving over leadership responsibility to somebody, you also need to give them, the ability to make their own decisions about the people that they think that they need. You should obviously weigh in with your advice. There's plenty of situations where I've been in interview processes where obvious red flags came along, where I was able to help out. But I think empowering the team is probably the most important thing, because I think, as the questioner is pointing out, you cannot lead every single member of a team. Some of these teams are vast in terms of their functionality, in terms of their location. Some of them are remote, some of them are in person. And so, having a leadership culture that goes down through the management process is really critical.
Yeah, great response there, Tim. I think we've got time for maybe kind of one or two more. So next one's from Mark Johnston. For companies that are not yet profitable, do you have tips, guidance on how to assess how much cash runway you need? And at what point, should you be approaching potential investors for the next round? Once again, we kind of touched upon this, but it'd be good to get just a quick summary on that.
Yeah, I mean, I think it varies. In some cases, I've seen VC investments where they had, for instance, 5 years of runway. And you see others where, the runway is much shorter. I think probably the more important question is there a path to profitability within a reasonable runway period while you're growing the company? So let's say you only have 12 months, but you have the ability to cut to profitability. I think that's probably just as important a question as how much runway do you need? So if you had to go back and say, could the business operate with less and still be successful at maintaining revenue or maintaining customer satisfaction? Those are some key questions that need to be answered. And again, you need to involve other members of the team in that process.
Yeah, great. And Tim, another question that's come in that came in just before this session. If you're a CFO, and this is coming from a CFO, they were keen to learn what else do you do to develop yourself now you've got to CFO. Do you do anything else externally? Read books, podcasts? Do you go on other courses? Do you join certain communities to keep yourself in the know of certain things, or yeah, how do you continue to develop yourself outside of your kind of main job, would you say?
Yeah, I mean, I think obviously there's CPE that's available. Beyond that, there's definitely some very good communities on LinkedIn, especially around CFO resources. There's a lot of good podcasts there. There's also some fairly inexpensive courses that are available from really reputable colleges. Chicago Booth, MIT are a couple where the courses are not as expensive as some of the others. I've seen some courses from more Ivy League schools where the cost is somewhat prohibitive. So I think some of those in a focused way, like if you want to learn about M&A, taking an M&A course on financial due diligence, for instance, could be really valuable. I think probably the more important thing is before you go down that path is to make sure that you have buy-in of leadership, that you have alignment of goals in terms of what the company is trying to accomplish and what you're trying to learn. And once you get that support, then it's a lot easier to execute on some of those learning opportunities.
Brilliant. Tim, it's been awesome. My apologies for the hiccup in reception here and there, but I think we got a lot out of this session, and appreciate your insights, and you provided such a breadth of different views across different elements of the finance and accounting function. So yeah, really appreciate that, and I think a lot of the attendees would have gained a lot from that. Dan, I don't know if you want to round off by saying a few words as well.
Absolutely. Well, thank you again, Tim and Dab, for such a great session, and great to see so many people come along to benefit from it as well today. There's so many great insights. I particularly pulled out a few that Tim mentioned, for example, that different expectation of different levels of investors as you go through the various different life cycle stages of a company. I think that's such an important one. And being a training, learning, and education business at GrowCFO is, I totally echo what Tim said about getting buy-in of your leadership team before you embark on courses, because it's just so important that you can embed the learnings into your role and they understand that you're trying to make that transformational journey throughout that program and beyond within your career. So yeah, absolutely great stuff. And as a reminder to everybody, so we'll post the video recording onto our learning platform, which is available to all of our free subscribers in the community. So do feel free to watch that back on demand. But again, thank you very much, Tim. Thank you, Dev. I hope everyone has a good rest of their day and evening, and we'll speak soon. Thank you.
Thanks, Tim. Thanks, Dan.
Thank you.
Bye.
Bye.